Hey, what's up, everybody? Coming to you from New York. I'm here until next Friday. Back here visiting my kids, and my mom is here, so yeah. Anyway, let's summarize what happened today. We had a mixed close. Dow, S&P down marginally. NASDAQ up. Here's what I want to talk about today. It's very important, if you want to learn, if you want to understand, if you want to avail yourself to information, you have to listen, and you have to listen very carefully. It's not going to be any help to you if you gloss over what is being said and you frame that with your own bias, because then you're just gonna fall into the trap of misleading yourself and taking any information, valuable information that could be, and just deconstructing it to fit into your own personal bias. And I'll give you an example of what I'm talking about. And you don't have to, you don't have to agree with me on everything, but I try to bring you concise information, and I try to bring you an understanding. And I try not, very hard, I try not to make it confusing or contradictory. Yesterday, someone posted up a comment, because I've been saying now we're going to have a very short-term bullish bounce in the stock market, but the overall picture now until like mid-November, maybe even until the third week in December, there's going to be some volatility, and there's going to be more or less a bearish trend, because I've been telling you this for months. We're going to have September corporate tax strain. We're going to have the September 30th budget negotiations in Congress, and that right now not looking too good, thanks to that Fitch downgrade, ridiculous, idiotic downgrade. Anyway, let's just say that the next couple of months, and this is also true seasonally for the stock market, the next couple of months looks a little suspect. But I said that in the next week, I even said that, how long can this bounce last? I said maximum a week. So somebody posts up a comment saying, oh, you're bearish, now you're bullish, then you're bearish, flip-flopping all the time. It's not flip-flopping all the time. It's just a deeper dive into the short-term environment. Now, I probably shouldn't even be doing this, because I'm the one sitting here making these videos every day saying, like, I don't day trade or swing trade the stock market. What I do with the stock market is I accumulate stocks over time. I wait for pullbacks. I add to my position, and that's how you build wealth. But at the same time, I know that a lot of you like the trading aspect of stocks. So I was just trying to provide some additional backdrop, or some additional characterization of maybe opportunities, short-term opportunities that exist right now. But if you come here and you say, oh, look, he's saying one thing and he's saying the next thing, then it's very, very obvious to me that you're not listening, and that's not even what's important. The main thing that I want to point out is that you're just deconstructing what I'm saying and reframing it to fit your own bias. Now I ask you, is that a beneficial thing? Is that something that's going to be helpful to you? I mean, there's good information and there's bad information. And your job is to kind of discern the difference. Now, I go to great lengths on this channel to try to educate. And I'm a big believer in education and knowledge. I point these things out all the time about how mainstream economics has it wrong, and actually how that's really a good thing for us because we can use that as opportunities to make money. I mean, whenever people or institutions have a flawed or erroneous understanding of things, they're going to act on that and they're going to be wrong. And over time, if you go against that wrong view, that's going to play into your advantage. But if you constantly want to deconstruct information or reconstruct information so that it fits into your bias, then the only person you're fooling is yourself. Okay? I mean, that's the epitome of self-sabotage. The only person you're fooling is yourself. I mean, you have to, I think, not just in investing, but in life, you have to have an open mind. I mean, Keynes, the great economist Keynes, once said, when he was asked, well, why did you change your view on this thing? He said, when the facts change, I change my mind, sir. What do you do? And that's exactly, I've always been that way. I've always been that way. So I haven't changed my view. I said we're going to have, at best, a 1 week rebound in the stock market. And it wasn't even going to be of much magnitude, but it is tradable. I mean, I bought some stock recently. I bought Apple at 172. I averaged down. I bought Apple at first at 178, and I bought it at 172. So my average is 175. I owned Apple, from like the 140s up to the almost 200, 197. Now it's back down, so I averaged out. I'm at 175. I'm in the black on that right now. It may not be over the next few weeks, but I'm fine with averaging down with Apple. I have no problem with that whatsoever. And if you want to get back to what my strategy is in terms of my own personal investing in the stock market, I mean, I think time is your friend. This is why I'm totally against short-term trading. But again, I put it out there for those of you who want to, swing trade or look for opportunities. But time is your friend. And I really wish they would listen to this freaking racket going on behind me, man. It's like, New York, baby! Oh, shit. Fucking jackhammers and shit. I can't believe this. Fucking unbelievable. And down here, it's really amplified because I'm right now, I'm down in the financial district. And this is like Concrete Canyon City, man. And just the noise echoes off of all the building. And the same way, basically, folks, I quote unquote, like grew up here in terms of my career. Like I've been here my whole entire freaking career, over 40 years. And this is, it's an interesting place, but it's a hellish place. In the winter, just to diverge a little bit from what I'm talking about, it gets really, really cold and windy and blustery down here because the wind, it whips through these man-made canyons, and it's there's very little sunlight because the tall buildings, they block out the sun, and it's brutal. And the roads are, the streets and the roads are, a lot of it is just like broken up. I used to run here some mornings, and it was very uneven, and it's construction all over the place. Anyway, I digress. So yeah, getting back to the markets, all right? Yesterday was a 10.7 billion fiscal drain, so that may explain some of the market, just what we saw today in terms of the market hesitation. I mean, again, NASDAQ was up. But also, we're going into tomorrow, I think, is the beginning of that Jackson Hole Symposium. That's that meeting, the meeting every year in August out in beautiful, beautiful Jackson Hole, Wyoming, with central bankers from all over the world. And you may recall, and I think I mentioned this yesterday or the other day, maybe Friday, that last year when they had that symposium, Powell spoke, and he's going to speak on Friday, and last year it triggered a tsunami of selling because he was really, really hawkish. But don't forget, at that time, the Fed was still in its, pretty much in the early stages of its rate hike campaign. Right now, I have to tell you that Fed fund futures, they're not predicting a rate hike at the September 20th meeting. So, that's something worth considering, because as I've said here like so many times, the Powell Fed is a 100% market following institution. I've even said, like, what's the purpose of having a monopolist central bank if all they do is follow the dictates of the market? I mean, it's just silly. It's just silly. That's like if John D. Rockefeller would go around asking all his little competitors, hey, what price should I set my oil at? I mean, no, he crushed them. He put them out of business. And he set the price. He was a monopolist. That is the power of a monopolist. And yesterday I used the example of the Bank of Japan, which didn't cave in to all the rate hike pressure. Think about this for a second, folks. I mean, you really have to think about this. And if I was in that meeting, whenever they have these Fed meetings, policy meetings, then there's always like a half an hour later, there's always a press conference. But if I was in that press conference and I got to ask a question of Powell, I would say, number one, sir, I have two questions. Number one, you're raising interest rates and it is not leading to an outcome that you expect. And how would you explain the fact that Japan, which is a major energy importer, like all their energy comes from imports, yet the Bank of Japan has kept interest rates negative and inflation is very low in Japan? How would you explain that? And why wouldn't you look at that as a critique, maybe, or at least to raise some questions about your own policy? And the second question I have is, if rate hikes were the answer to inflation, then how can you explain the inflation in Argentina and Turkey, where both of those countries have seen multiple rate hikes, and every time they hike rates, the inflation gets worse and worse? I mean, those would be the questions I would ask. Those are obvious questions, and they need to be asked. And the incredible thing is, like, all of these journalists, and you have this guy, Steve Leisman from CNBC, and he's always in there, and he's always allowed to ask a question. He never asks a question like that. Nobody asks questions like that. Those are the questions that need to be asked. Like, sir, if your method is based on the scientific method, which is to test a hypothesis, and if the empirical evidence is not consistent with what you believe the outcome should be, don't you go back and look at your hypothesis and maybe, ask some questions, make some changes? No, they don't do that. They just stick with the same thing, and they think, oh, it's got to go more. We just got to keep doubling down and tripling down. I think their playbook is, goes back to Volcker. And actually, if you're honest about the Volcker playbook, he was the guy that accelerated the inflation impulse in the late 70s into the early 80s. Okay? That was what accelerated the inflation impulse. And then, we had the deregulation of the oil and gas markets that caused a big drop in oil prices. And then the Fed basically followed that. And when they started to cut rates after energy, and don't forget, energy back then, if you don't know this, energy was a much larger sector of the U.S. Economy. It had a much larger impact than it does right now. But when those prices started to fall, the deregulation, you had the deregulation of the airlines, you had the deregulation of the energy sector, the Fed basically followed the inflation trend, and once they started to cut rates, inflation came down significantly. So that's all. And in my course, and I think it is in my Forex trading course, I go through those charts and I show you the correlation in the years that we saw the Volcker rate hikes and what actually happened to the dollar and inflation. I show you that very clearly, like, year by year. You could chart that, and you could see every time that Volcker raised the interest rate, inflation went up. And again, I submit to you that the example right now, 3 examples on the positive or negative inflation side. In other words, inflation going up. You got Argentina, you got Turkey, which they keep raising rates, and then on the positive inflation side, with inflation stable or coming down, you have the Bank of Japan, which it hasn't fallen in line with the other central banks. So this is all MMT understanding. And again, it just gives opportunity. You got to be patient, though. You got to be patient, because you're going to have the zombies. They're going to be reacting, and they react on the basis of their lack of understanding or their erroneous understanding. And so you want to go against that. You got to be patient. It's very important as a trader. You got to give yourself enough room, especially if you're leveraged, because I've had people and subscribers say, Mike, I got stopped out or whatever, because you're going too heavy. Time is your friend, and if you understand that, you know that it's much better to stretch things out over a long term than to say, I want to make $1 zillion next week. That's just going to get you in trouble. All right? Anyway, folks, that's it for me today from the concrete jungle, New York. I'm missing Cali. I'm telling you, I can't wait to get back. See you guys tomorrow. Don't forget, and I have to say, a lot of you have been going to my website and signing up for MMT Trader. I'm very thankful for that, and not just for me personally, but I want to help you guys. I want to educate you guys, and you're not going to get that kind of information anywhere else. You're just not going to get. And today I saw something on Twitter where I forget the guy's name, but he's a well-known economist here on Wall Street. He did this very straw man, shallow, ridiculous critique of MMT, and it was just a straw man argument. And I could bet anything, and I'm gonna put up a Twitter post. I will bet you anything that this guy's comments, or this guy's he has a economic research firm. Jesus, what the fuck is his name? I forget. Anyway, it doesn't matter. But I will bet anything that his clients have not made any money whatsoever, over the last year and a half. I would bet anything that his research has been totally useless. He's probably got a big client base, probably has a big corporate client base, probably, has a big firm. I will, and I'm saying this in all honesty. You guys who have been following me, you could run circles around this guy right now. 100%. I will bet anything that his clients didn't make any money. Because with the wrong understanding, you're not going to make money over time. You might make money in the short term, but the market and reality will take it away. All right? So sign up. I'll see you guys tomorrow. Bye.